So we come to our second panel for the day, which is on systemic liquidity. The panel is chaired by Stephen Cecchetti, professor at Brandeis International Business School and vice chair of the ESRB Advisory Scientific Committee. And he will introduce the panelists. Over to you, Professor.
Thank you very much. And let me start by thanking the ECB and the Secretariat of the ESRB for organizing such a nice event and taking such good care of us while we're here. And let me also thank all of you, both those of you who are obviously here in person and online, for listening in and for participating. It's my great pleasure to chair this panel. Before I get to the fantastic and eminent speakers, let me start with a few comments. And I'll start with a very short story about my time at the BIS, which was now longer ago than I would like to remember. Probably not longer ago than maybe Hyun would like to remember, but it was a very long time ago now. You may, when you have jobs like that, you don't realize. When I was there, which had started in July of 2008, which was a sort of interesting time to be in the official sector, I got there and people started using this term liquidity. And it had been a while since I'd been in the official sector. I didn't understand what they meant, so I sort of made this rule. I wouldn't call it a rule, it was a guideline. I said, well, it would be really helpful if every time you use the term liquidity, you modify it by something. And that was fine for a little while because there was market liquidity and there was funding liquidity, and I'll come back to that. But then there was global liquidity. And at that point I felt defeated. Because now again we had something. But fortunately today, Linda's going to help us understand global liquidity. But my job is not about global liquidity per se, but about systemic liquidity, which is another defeat at some level from my perspective. Because what is that? And I think that it's useful to start at least with a definition. Again, you know, unless you have some sort of axioms for your system, you can't figure out what you're talking about or why you disagree with people. And so in the case of systemic liquidity, at least the way I think about it is that it is a breakdown of intermediation more generally, and that arises from some combination of funding liquidity breakdowns, which is a reduction in the ability to borrow, and market liquidity breakdowns, which is a breakdown in the ability to transact and to convert assets into cash, whatever that might be in the modern world, which we will leave that's for the next, maybe we'll have that as the next ESRB conference. We can discuss what transactions assets are or something, I don't know. So each of these, of course, have numerous sources, that is these liquidity and the liquidity risks. But the ultimate issue, I think, is that we're left with several questions certainly as the European Systemic Risk Board and all the national authorities, the supervisory authorities, the central banks, and the market regulators, as well as the private sector, with a series of questions. And that is, so the first one, that, as I would put it, would be, can we measure systemic liquidity at all? And then, assuming that we find some way to measure it, can we actually anticipate when risks might arise? So this is about anticipation. And the second question is whether we can create systems that prevent breakdowns in systemic liquidity, which is, again, these abilities to obtain funding or ability to transact or ability to move funds across borders, which we'll come to. And prevention often has to do with creating capacity. And so are there ways that we may be able to do that? And the final one is about mitigation. And mitigation, I think, is something that those people like me, as I think of myself as a central bank groupie. I hang out with central bankers, but I'm not actually a central banker. But I seem to be attracted, and I like to, fortunately, there aren't a lot of people taking pictures, so there aren't a lot of pictures of me with central bankers, but it's certainly would be possible to do. But in any case, so if you think about mitigation, and we have these institutions that are in place then whose job it is that if these risks arise, if they materialize, that those institutions' jobs are to try and mitigate it. But before we get to that point, our hope is first to be able to measure and anticipate, second, to be able to prevent or increase capacity, and then we would actually turn to mitigation. So, with that as a very brief introduction, let me now turn to the panel, and let me introduce all of them at once. So first, on your far left is Linda Goldberg. Linda Goldberg and I had the real pleasure, and it was truly a pleasure to work with Linda briefly in the late 1990s during the period of the Asian crisis, the LTCM collapse, and the Russian default. I'm actually not allowed to go back into the official sector, by the way, because it only happens when there are crises. But Linda has been the senior vice president at the Federal Reserve Bank of New York, and at various points done many things, including being the head of international there, being involved in a number of international cooperative activities, including things at the BIS, being involved in being an NBER research associate, a fellow at the CPR, which many of you know about these things, and she leads the American chapter of the Central Banking Economic Research Association, and she's got a tremendous research record as well. And if there's someone that you want to turn to ask about global liquidity and to ask about cross-border capital flows, you can't do much better than asking Linda. Next to her is Rafael Repullo. He's a professor at CEMFI in Madrid, where I believe, if I'm correct, he was the director for the entire life of the organization from the first day until about a year ago, and somehow, while he was building and running this organization, he was also able to do cutting-edge research in finance, and so in banking and in banking regulation. And so we're really excited to have him here. Next to him is Hyun Shin, who is economic advisor and director of research at the Bank for International Settlements. My joke about the BIS once was that the titles were so long you had to figure out how to fit them on your business card. My title was longer than that when I was there. But Hyun had an amazing academic career doing fundamental work in macroeconomics and finance, and at the border really early of what we now think of as macro finance research. First in the UK at Oxford and the LSE, and then at Princeton before someone managed to convince him to move to Basel to take over as a co-head of the monetary and economic department when I left, and it was a lot easier to leave, I have to say, knowing that someone like Hyun was coming to take over. And finally, there's Erik Thedéen, who is currently the governor of the Riksbank, and I was less aware of your biography and your naval history, but Erik, I did meet you though, I think when you were at the FSA. Erik is currently, I think the most important thing is that Erik has just taken over the chairmanship of the Basel Committee on Banking Supervision. So we're extremely pleased to have him here. And as someone who has been involved in the Basel Committee now for the better part of 25 years, I can say that I'm extremely pleased that you agreed to take that over. So with that, let me turn it over first to Linda, and then we'll go down in that order. So thank all of you for coming.
So thank you, Steve, for that kind introduction. We can take a photo together later if you want a picture with the central banker.
I know. I want a photo with. It's got to be
Good.
Sorry.
Good. No problem. So I'm going to speak today about global liquidity and international roles of the dollar, and of course the views are mine and not necessarily those of my institution. So just a little bit of a roadmap for the comments. I'm going to talk a bit about how global liquidity, and I'll define it specifically, but this is about financial flows that are moving around the world, different currencies moving around the world. I'll give you a schematic representation of the channel, which I think is useful for framing the discussions also by the other panelists. I will give a little bit of quantification of the evolving financial structure and changing key players, and then emphasize the roles of the dollar in financial transactions. And as I always do when I have this discussion, I point to the ECB's international roles of the Euro report as the best source out there and most comprehensive source about all of these roles. And we, with Francesco, we met many years ago when that report was actually being formulated. Then I'll turn to systemic liquidity considerations and talk about how they're, and this ties into the address we heard just before lunch. I'll talk about how these flows are evolving and how sensitive they are to different kinds of risk conditions, and that prudential policy plays a role in those sensitivities. I will mention swap lines and FEMA repo activities. So these are the kind of networks. Some of these are the networks through which if there are dollars needed, liquidity needed in locations in systemic stress periods, how some of those dollars flow, and about the use of facilities under systematic or systemic and idiosyncratic strains. So that's where we're going. So global liquidity, you should think of, I think of, as the key component of international capital flows, like portfolio flows. And it's the volumes that are intermediated largely through global banks, but also through non-bank financial institutions, and that's a diverse set of institutions. And this is the kind of funding flow that can reallocate at high frequencies. Within that, there's official liquidity. That's the components that are created by central banks. But then there's the whole private liquidity side, which is what we generally are concerning ourselves with in these discussions. Those are the funding conditions for the broader international economy. It reflects the behavior of the financial sector. And we really do want to have conversations about what happens under stress. And what happens in terms of domestic flows, what happens in terms of cross-border flows, and also what happens when the funding flows are not in your own currency. Key drivers of global liquidity flows are often put under the heading of the global financial cycle, but basically it's monetary policy, and usually the U.S. monetary policy is called out in this regard. And some of the roles of the U.S. monetary policy are due to interact with the dollar's use in a range of financial transactions. Another driver will be risk conditions, and those risk conditions, and here we've learned a tremendous amount from Hyun over time, those risk conditions engage with the vulnerabilities and the constraints on financial institutions. And then regulation, not just regulation, but also supervision, play a role in these sensitivities. Prudential instruments matter. And very important, too, is the composition of borrowers and lenders and the home and host country conditions. So here's a schematic that I'll try to walk you through very briefly. These are about the channels and institutions involved in global liquidity flows. And I have an article that kind of talks about the stages, the evolution over time. But basically, you can think of this orange dashed box as being an economy. Within that economy, there are domestic banks. There are non-bank borrowers. There are also now hosted foreign banks. And outside of that economy are global banks and non-bank financial institutions and BFIs. And from the global banks, their flows cross-border, their flows of global liquidity go through cross-border lending channels, and those are bank-to-bank flows. They are from the global banks to their affiliates in these locations, who then on-lend in the domestic economies. The global banks do direct lending to non-bank borrowers. They also now increasingly fund into international debt issuance. And then there are non-bank financial institutions that are funding both banks and all of these non-bank borrowers domestically. So the state of play right now is all of these channels and all of these players, different from what it's been historically. The composition of global liquidity has evolved for borrower types. The upper panels are representing flows vis-a-vis advanced economies, the bottom panel with emerging market and developing economies. The red boxes are cross-border loans, the things we traditionally associated with banks. The blue are flows for financing international debt issuance. And what you can see from this is that for non-bank borrowers in both advanced and emerging markets, the funding is now primarily, the majority of funding is through these international market-based funding, not through the banks, although banks still play a prominent role, whereas the bank-to-bank activity is still prominent, both in advanced economies and emerging markets. And these are large volumes of outstanding positions. In terms of why dollars and U.S. policies, for many reasons get attention, but here is a snapshot of the international monetary system from the June International Role of the Euro report. The parts of this picture represent foreign exchange reserves, international debt, international lending activity, international deposits, and foreign exchange turnover. The blue bars are the dollar share, and you could see that the dollar shares within all of these functions in the international monetary system are high, and they have remained high for some time, followed importantly by the euro in all of these functions. So just a couple of observations about how risk events, and Steve will want me to define terms, and I think that for risk events, we could think of two things. One would be, what is the level of risk out there? And the other is, what are the attitudes towards risk-taking that are out there? So there's risk sentiment as well as risk levels. So, as policymakers, we are concerned with reducing some of the amplification of shocks while still letting markets function well and capital be allocated to efficient usage. Amplification, when that occurs, interacts with institution-specific constraints and frictions. One thing in my own research that I'm finding continually is while we often focus on policies within our home markets, in this international setting, it's very important to look at the source country policies and their source country microprudential as well as structural policies, which if there are strong capital and liquidity frameworks in place that are reflected by the institutions, increase the resilience of flows internationally and reduce their sensitivity to risk. When we look now compared to before the global financial crisis, the bank-based global liquidity flows are far less risk sensitive than they were previously. And a lot of that is associated with improvements in risk management, improvements in both regulation and supervision, and importantly, consistently, the research out there shows that it's related to bank capitalization rates, which provide buffers for absorbing shocks. Prudential policy, regulatory quality, also are important, along with also the non-bank financial institution characteristics. We had some discussion yesterday and today about, what frameworks do we want to have over non-bank financial institutions? I think we always have to be conscious of risk migration, which routinely occurs, and now we're seeing higher sensitivity of non-bank financial institution flows to risk relative to some previous times. Within banking institutions and within official bodies, there are other policy approaches that have stabilized against some of these risk condition changes. First, financial institutions self-insure, and some of that work, even in global banks, through internal capital markets is often stabilizing. Sovereign economies have official reserves for dealing with cross-border foreign currency liquidity constraints. And of course, there are official liquidity facilities with changes in pricing, tenor, and access. I'm very much out of time, but I just want to show you two charts. One is how much has flowed through the central bank swap lines, in particular the ones of the Federal Reserve, in a couple of systemic stress periods, and three periods are the peak usage. The first is when all of these were really set in place. That's in the global financial crisis, where the usage peak was $590 billion in December 2008. Then in the Eurozone fiscal and banking crisis, where it got up to $110 billion of dollar usage. And then in COVID-19, where the usage peaked at $450 billion. Now, in the end of March 2020, during the COVID period, the Federal Reserve also set up a repo facility called FEMA repo. Oops, wrong direction, sorry. FEMA stands for Foreign International Monetary Authority, so these are account holders of the Federal Reserve. A lot of reserves, for example, are managed by the Federal Reserve internationally. And you have two scales here. One in red is usage below $2 billion, and so there's a lot of that kind of small-scale usage that regularly goes on, also testing these lines. And then there is usage that occurred around the Credit Suisse events, and that's in the blue bar. And so this allows countries basically to liquefy instead of liquidating some of the assets that are under management at the Federal Reserve. So I'll end with that. and then we can have more conversation later. Thank you.
Okay, well, I'm not sure that I should thank Steve for inviting me here. It is true that I have done a lot of research on banking and banking regulation, but none on liquidity risk or liquidity risk regulation. So I told Steve that this was the case, and he said, well, it doesn't matter, you'll figure out something to say. So anyway, so this is my attempt to do. Now, by the way, I'm going to be talking about banks. I'm not going to be talking about, and therefore, mostly about funding liquidity. Basically, nothing global, nothing, almost nothing market. Okay, so this is the overview of what I'm doing here. I will start with a discussion of solvency versus liquidity in the context of systemic risk. I will review some of the academic rationales for the Basel liquidity standards. I will present some new evidence on systemic bank runs, and I will discuss an alternative approach to thinking about liquidity regulation, and then I will conclude. Okay, and so let me start with solvency versus liquidity. I want to use this sort of very simplified balance sheet of a bank, which basically has assets and debt and equity. Debt is deposits, of course, but other types of debt and equity. Now, let's think about a solvency shock here. Well, suppose that you have some losses in your market portfolio that obviously translates into one-for-one reductions in your equity. And the impact effect is that you are going to have less capital, but then there is some secondary effect that you may want to sell assets to reduce leverage, and this may have some sort of amplification effect. Now, let's think about a liquidity shock. Well, typically, think of a depositor run. Well, the debt of the bank goes down. Then you can do two things. You can sell assets if you can find a buyer, or you can raise new debt if you can find a lender. And that's, but notice that the equity, in principle, would remain unchanged. Now, it is clear that we can have aggregate solvency shocks. Think of the bursting of a real estate bubble or some sort of things like COVID, for example. And in those cases, this is going to lead to a depletion of banks' capital in the aggregate, may lead to a credit crunch. And importantly, the central bank can inject liquidity, but not equity capital. Now, this is obviously the justification for macroprudential policy with respect to capital, and then we have these countercyclical capital requirements of Basel III. Now, contrast this with a liquidity risk. Now, an aggregate liquidity shock is much less likely to happen. Why is that? First, because depositors typically run to other banks, safer banks, so it doesn't evaporate. I mean, this liquidity moves within the system. Secondly, because if you're talking about rollover of some short-term wholesale funding, the lenders will try to find other borrowers. And finally, because the central bank can inject liquidity. So therefore, I mean, this points out that these two types of risks are very different. And from a systemic perspective, solvency and liquidity are different, and in thinking about the design of macro-prudential policies, the focus should be on capital buffers, not on liquidity buffers. Okay, so now let's move to the second part of my presentation, which is rationale for the Basel liquidity standards. Now, I can think of two papers. Both of them have Javier Suarez sitting over there as a co-author. The first paper is something that they publish with João Santos from the New York Fed in the Journal of Financial Economics, 2019. And the story there is that liquidity buffers buy time to discover the bank's true solvency. And this is going to lead to a better decision by the lender of last resort. The second paper is something about fire sale externalities associated with wholesale short-term funding. And what they show in this paper, this is with Enrico Perotti, is that liquidity buffers partly correct the externality. So these are two ways of thinking about why we should have liquidity buffers like the LCR. Now, looking at the first rationale, well, the possibility of very fast runs like we saw last year with Silicon Valley Bank and the other mid-sized US banks, basically leaves no time to discover anything, right? You have 24 hours, which means, or requires implausible increases in the LCR. So I think that we better think of an alternative rationale, which is the one in the other paper, the Sveriges. And then what they show in that paper is that there is this fire sale externality. The quantity standards like the LCR partly correct the externality, but they are distortionary, right? Limiting the investment of more efficient banks, limiting maturity transformation, and then the investment of the more efficient banks. Now, what they show also is that Pigouvian taxes would be better. And so the question is, how can we implement Pigouvian taxes, at least approximately? Well, one possibility, which I don't think they mention in the paper, is through capital requirements. I mean, if equity capital is costly, then that would be the way of sort of trying to approximate these Pigouvian taxes. Right, so summing up, capital requirements on short-term wholesale funding have these two effects. They increase funding liquidity through higher solvency, and they correct incentive for excessive borrowing short-term. Okay, so now let me move to part 3, new evidence on systemic bank runs. Now there is this paper, recent paper by Jamilov, Koenig, Müller, and Saidi. It is a monumental, I mean, it's 250 pages, okay? So there's a lot of stuff there. They look at bank runs in 184 countries over the past 200 years, and they have many sort of facts that they uncovered there. And in particular, I want to, this is from the abstract of the paper. They write the following. In historical and contemporary episodes, depositors tend to run on highly levered banks, causing a credit crunch and a reallocation of deposits across banks. I would like to stress two things in this statement. First, the link between bank solvency and incentives to run, right? They run on highly levered banks. That's the evidence that they produce. Secondly, the reallocation. The deposits run to other presumably highly capitalized, safer banks, right? Okay, so I want to use this as a motivation for what I call the alternative approach, which is not really an alternative approach. I mean, in 2014, Erik Rosengren, at the time president of the Boston Fed, wrote in a speech the following: perhaps the most direct way to reduce runs related to unstable funding is to require financial organizations, depending on unstable funding, to hold significant more capital than they would if they use stable sources of funding. Okay, so, and then of course, something happened the year after, 2015. The Federal Reserve implemented this final rule on G-SIBs, and they introduced two ways of calculating the surcharges, and the requirement was to use the higher of the two. And the first one is the Basel method. The second one uses the same sort of criteria, size, interconnectedness, cross-jurisdictional activity, substitutability, and complexity, but replaces substitutability with a measure of the firm's reliance on short-term wholesale funding. Okay, does this matter? Is this significant? Well, method 2 surcharges have been binding for all the 8 US G-SIBs since they were introduced. And the difference between method 1 and method 2 is very significant, in some cases up to 200 basis points. So we're talking about really hefty additional charges for the G-SIBs. And this is a picture that shows for the 8 G-SIBs, the green bars are the method 1, the Basel method, the pink bars are the method 2. And notice that by 2 banks in this picture, which are JP Morgan and Morgan Stanley, we're talking about 200 basis points additional surcharge. Okay, so let me just conclude to be within my 10 minutes of time. First of all, I would like to say that from a macroprudential perspective, the focus should be on capital buffers, not on liquidity buffers. So this idea that we should have macroprudential policy for every risk, I mean, let's look at the important part, which is the capital buffers. Now, with regard to the capital buffers, this is something that I've done some research, as Steve knows, that the move towards a positive neutral CCYB, I think, is most welcome. Claudia Buch mentioned this yesterday, and there is this document by the Basel Committee, buffer usability and cyclicality in the Basel framework, that has this sentence: the committee supports and sees benefits in the ability of authorities to set a positive cycle-neutral CCYB rate, which means that we know that the credit to GDP gap is dead, so it's time to be buried, and then let's have something like this in place. Second, on the liquidity front, I think that microprudential liquidity regulation is, in my view, in need of repair. I think that it's important to recognize the connection between liquidity and solvency risk. I think it would be desirable to break this silo approach that the Basel Committee has followed. And from this perspective, what would I recommend? And I know that the chair of the Basel Committee is sitting here, so I apologize if I say something that is too inconvenient, but you know academics are sort of like that. I would like to propose that the LCR should emerge with the NSFR. And because the NSFR, as Steve has proved in a number of ways, is just an LCR with different weights. So I think it doesn't make much sense. It generates all kinds of arbitrage opportunities. I think that it doesn't make sense. But I would say let's keep it like that. This would be like the backstop. This would be like the leverage ratio in the case of the capital regulation, something that will prevent some banks to doing something a bit crazy. And then I would introduce capital charges for liquidity risk in an open manner, not in a somewhat hidden manner through the G-SIBs surcharge. And that's all from me. Thank you very much.
Thank you very much. And next, Hyun, who will speak from here.
Well, thank you, Steve, and thank you to the ESRB for laying on this very timely event. It's been a very stimulating event. What I'd like to do is to actually follow up on what Rafael's been saying about the banking sector, but also connect it with a non-bank discussion yesterday in the afternoon, and address actually the title of this session, Steve, which is systemic liquidity. So what could it mean? And let me offer one perspective, which I think will touch on also global liquidity. So I promise to come back to that. I think there is a duality here between risk-taking and risk management. And in a way, they're two sides of the same coin. So risk management doesn't mean the absence of risk-taking. It's actually taking risks, but mitigating loss. And if I can just put in a shameless plug for my book, Steve. So in my Clarendon Lectures, volume, I open with a quote from, and this is a real quote, a quote from the chief risk officer of a major financial institution in the spring of 2007. And this is what, and I wrote this down because it was so striking. He said, the value of a good risk management system is that you can take more risks. And you can see exactly what he's saying. Look, take risks, but at the right time, you can mitigate loss by taking evasive action. Now, of course, mitigating loss is a very effective strategy from the firm's own point of view. But that mitigation of loss can also inject externalities into the market as a whole. Or if you're dealing directly, it can also actually amplify stress in the case of some of your counterparties. So let me give you some examples. Well, let me sort of put it in very general terms, and let's come back to some of the examples. So, for example, you sell when the price falls. I mean, that's a very natural risk mitigation strategy. But of course, if you're selling into a market that's already declining, you can accelerate the loss. You cut lines when the market becomes very stressful. It's because your risk goes up, and therefore you cut lines. From the point of view of the borrower, that looks like a run. We saw plenty of that during the GFC. Of course, the institutions have changed. So, whereas the run-up to the GFC and the stress at the height of the GFC had to do with the dealer banks. So this was very much on balance sheet. In some of my work with Tobias Adrian, we see this, if you go to the flow of funds, you see this huge run-up in both the assets and the leverage of the broker-dealer sector. Leverage reached 50 in 2007. Of course, now it's come all the way down. It's 14. And it stayed down because the channel of intermediation has also changed. So whereas banks have really taken some of that risk-taking away from the balance sheet, of course, it's some of the other, the non-banking institutions, including financial market infrastructures, that have really taken on the role, if you like, of a synthetic of the kind of synthetic dealer activities. So, for example, you could lay on the same type of risk taking positions using, let's say, repos that are cleared through a CCP, or you could even have a long-short strategy by also simultaneously engaging in a short position in the futures market. So this is what many of the hedge funds now are very fond of doing. So in effect, it's the same activity. And yesterday, in the panel, you talked about the dictum, same activity, same risks, same regulation. Now, that's easy to say, but very, very difficult to pin down. And actually, I think in this context, there's a very important paper which I was a discussant for. It came out in the Brookings papers, this paper by Andrew Metrick and Dan Tarullo, called Congruent Regulation. And congruence means same activity, same risk, same regulation. What it means is, functionally, if what you have is effectively a dealer bank type of operation, then we should think of regulation, covering those activities in a similar way. I think the financial market infrastructures, take on a great deal of importance here, because they are now, if you like, at the center of that intermediation activity. Whereas the banks are subject to the leverage ratio in Basel III, I think it's fair to say that that equivalent set of measures for the cleared segment is still a work in progress. I mean, there's a lot on transparency, there is a lot on the user risk management, but I think on the idea of finding congruent regulation, that's still somewhat of a work in progress. Now, how does this relate to global liquidity? Let me say a few words and conclude. So Linda, I think, gave a very, very good overview of what global liquidity feels like and what it is and how you can define it. All the charts that she showed you were essentially balance sheet aggregates. So on balance sheet aggregates of one kind or another. There is, in fact, a very, very interesting set of issues which have to do with FX swaps, which in some ways could be even more important than these on-balance sheet aggregates. So FX swaps are actually a very, very large part of the financial system, especially of the international financial system. If you go to the BIS webpage, the latest reading sort of tells you that the outstanding amounts of FX swaps in all currencies is around $100 trillion. And that's much larger than many of the other aggregates that we deal with. And remember, FX swaps are not like other derivatives transactions where the principal is not due. FX swaps are instruments where the principal is actually due. Contractually, what you're doing is you're providing, let's say, dollars in return for yen, with a promise that you will reverse that transaction at a fixed point in the future at an agreed exchange rate. So once you've done that spot transaction, you actually owe the principal amount. So in that sense, it does have the attributes of debt. And yet, accounting conventions treat that as off-balance sheet, and therefore it's not debt. And it's not captured in Linda's charts. Now, this is not the right venue to discuss the accounting, the finer points of the accounting here. But occasionally, and we saw it in the GFC, and most recently during March 2020, when effectively, when you've gone through this collateralized borrowing, so in effect, if you're a euro area insurance company, but you want a global portfolio, what you do is you enter into a swap. You borrow dollars by pledging euros as collateral, but with a promise to unwind that. But what if, having invested the proceeds of that swap, so you've bought illiquid assets, suddenly there is a liquidity stress event, like in March 2020. Well, unfortunately, although you have no currency mismatch, you have a maturity mismatch because your dollars are due tomorrow, but you are sitting on all these illiquid assets. And this is why in those charts that Linda showed you, it's the advanced economy central banks that had to engage in these dollar swap lines in order to provide the dollars to the institutions. Let me just finish with one thought on the events of August. We saw a very sharp period of stress. It was very short-lived, but it felt very intense at the time, and it involved the yen. Mostly global liquidity and the swaps have to do with dollars, because most institutions would like to borrow dollars in order to invest in dollar assets. But there's no reason why you couldn't borrow yen for various reasons. And it's actually quite a, I mean, we've written a few things actually at the BIS, especially the most recent quarterly review, where we try and piece together how large the yen carry trade might be using swaps. And it's actually, potentially, it could be quite sizable. So the amount of FX swaps outstanding with yen on one side is around $14 trillion worth. So that's a pretty sizable amount. It's around 50 times larger than the on-balance sheet numbers that we would look at in the BIS banking statistics. So what I'll conclude with is just a couple of points. So I think the definitions matter. The fact that swaps are not counted as debt means that it opens up a whole range of balance sheet operations. This is why the FX swap basis spikes at quarter ends and year ends, because banks know that this is not going to count towards the leverage ratio, so they exit the repo market and enter the swap market. So definitions do matter, and measurement matters. I think it's also very important to keep in mind the general principles here. So irrespective of the institutions, irrespective of how the market is organized, we have to think about the essence of the economics. And if possible, we have to use congruent regulation. So let me finish there.
Thanks very much. Finally, Erik.
Thank you very much. And we have one central bank groupie. I'm an academic groupie, so I like to spend time with academic, not being one myself. And you mentioned my naval career. And actually, my naval career is very short-lived when I was substantially younger, but it's proved to be very good now because we have this geopolitical situation, not least in my part of the world. And of course, having some knowledge about security policy is actually an advantage, even in a position as being governor of the Riksbank. So that as an introduction. So I will take some lessons, practical lessons learned from basically the crisis that have been unfolding, I guess, globally, but also for sure in my country, and see if I could kind of connect a little bit what's been said before here. So, of course, if you look on, and I will actually speak in the capacity of the governor of the Riksbank, not the Basel chair, because my first official speech in that capacity will be in a couple of weeks' time. So, but I take this as a learning session to listen to all thoughts about the regulation on the Basel from the Basel Committee. So if you take where we come from, of course, we had a huge banking crisis in the beginning of the 90s in Sweden. That was a solvency crisis. It was actually also linked to a fiscal crisis, which I think is kind of topical now. That kind of made the crisis even worse. We had 12% deficit to GDP. We had a government debt at 85%. And then we had this big kind of losses in the banking system. It ended up in a full state guarantee, the whole banking system issued in the press release.
So that's basically saved. That crisis that then ended up in bad banking and all that, and we learned a lot from that. At that time, the banking system was 100% of GDP. Now it's 300% of GDP. So that tells you a story. If we'd end up in something similar now, it of course would be much worse. But we have learned a lot. So the reforms after the global financial system have, of course, increased resilience, capital have increased, liquidity has increased, and we're taking, which ESRB is a good example of, a systemic and international approach, which is extremely important. Increasingly, we're also talking about non-bank finance, and I think that's, looking on the graphs here now, non-bank finance is actually bigger than the banks. I would like to mention that this is not only about capital liquidity we're talking about non-bank. Mutual funds is, of course, a very, very important part of the non-bank side. I think the liquidity management tools is an underestimated tool to actually handle runs in that sector, and I will take a practical example from my experience. When COVID broke out, we had runs on the corporate, the real estate bond funds. So basically, retailers were moving out their money from the funds, and the funds needed to sell corporate bonds. So liquidity, both the liquidity in the fund, but then liquidity in the market, the corporate bonds. And eventually the central bank, the Riksbank, had to intervene in the corporate bond market. At that time, we also used liquidity management tools, i.e. a coordinated effort to close temporarily the funds from outflows. And I think that was a really timely and good way to handle it. So if you talk about swing prices, gates, things like that in the funds, that is also, I think, a macro potential tool that is important. It's not only liquidity and capital. And also, I think another good example of some unintended consequences of the lessons learned from the global financial crisis. Of course, we had a lot of focus on making transactions more centrally cleared at the time. A couple of years ago, when the Russians' unlawful war in Ukraine started, energy prices went up dramatically. Energy companies became extremely profitable. But they have hedged part of that price risk in derivatives markets. So these extremely profitable, highly solvent companies ended up facing large collateral claims from the CCPs. So large so that the banks that handled these transactions for them couldn't handle any longer, to some extent due to the leverage ratio. So in the end, the government actually issued a state guarantee. So that's typically, I think, an unintended consequence. It's no solvency issue. This was a CCP, a very tough regulation. It should be, but it actually ended up in things that could have ended up. So there you have kind of, I guess, a dash for cash event that was problematic. So let me say a few words on the liquidity runs, and I totally agree. To have only liquidity runs without any solvency issues is probably unlikely. But of course, we saw the Silicon Valley Bank runs. I think that tells, anyway, a story which has been talked about a lot, but I think is important, and I have also here an example, that the combination of mobile banking and social media and deposit makes the inertia in deposits substantially lower than it used to be. So we looked into this in the Swedish banking system. So some of the smaller banks, they have 90% of deposit from deposit internet platforms based in Germany. So basically, the deposit came from clients going into internet pages where this algorithm chooses the best deposit in some bank in the Swedish context. This is, of course, true for other jurisdictions as well. So when I think of this, I guess that the run risk here is higher than it used to be when you had your bank that you always had and your parents always had, and all of a sudden this is now based on a web page. So I think the run risk, in combination of this, is higher now. And could you really think of inertia in deposit in the world of AI? I think this fundamentally will change, I think, some of the liquidity, thinking around liquidity and runs on banks. And that also brings me to the discussion about banking as a group. So typically, also in the Basel context, we talk about large, globally important banks and then smaller banks. So large banks we typically will put into resolution if they end up in big problems. The smaller banks we could actually end up in a kind of normal procedure. But if you have, let's say, 10 banks engaged in consumer lending, the same business model, same activity, if you like, and one of them end up in problem, the risk, of course, that same problem will see in other banks, and then you have run on the bank as a group. You saw a little bit of that in Silicon Valley Bank, but I think you could see it also in other jurisdictions. So this is something that fundamentally changes the way we think on stability in bank, because we typically think of stability or the risk of instability with larger banks. So I think that's something that we also need to think of. A few words, as I'm the central banker here, about the role of the central bank. Of course, we often talk about the central bank as the backstop, and of course, in one way or the other, we are. The balance sheet of banks has changed a lot recently. So basically, after the QE, we have been flooded with liquidity. Basically, now liquidity is in the form of bank reserves. Our own balance sheet went up from like 400 to over 1,000 billion Swedish, so that's 100 billion euros, so that's a large balance sheet. So basically, we had a corridor system where we have an interbank market. Now we don't have that any longer. We basically have a floor system, although we still would like to go back to a corridor system. But banks tend to, they're not forced to, but they tend to want to have reserves. And of course, this is a fundamental change, I think, in the way we look on liquidity, maybe both positive and negative. The negative thing is that we might not have an interbank market any longer. So what we are thinking of is, as we are doing QT, reducing our balance sheet, of course, the need to have more of an interbank market will increase. Will that happen? Are they prepared? Do they have actually the skills, or are they willing to do, or do they, by demand, want to have more of reserves? And that also, I think, is an important part of the liquidity. So there was mentioned here counter-cyclical buffers, and I have a lot of practical experience of that, actually. So we raised the CCYB to 2.5%. And that was because of basically increasing credit and asset prices. So that was kind of part of how the CCYB should work. So we ended up at 2.5%. COVID broke out. We slashed it to 0%. And it was extremely welcomed by the banks, because basically what they said, okay, now we have usable capital. So now we have capital that we could use avoiding a credit crunch. So I totally agree that the CCYB, to me, is a success. What we learned was that some other countries didn't have this positive CCYB. Why? Because they hadn't seen this kind of upturn in asset prices and in lending and in credit, which was kind of part of the setup of the CCYB. So then we and many others ended up to have a positive neutral, which I think is a very, very good, and we were, I think, at the second or third country in Europe introducing this, which I think is a very, very good way to handle it, because even if you don't have this credit explosion, let's say, before, and you have a normal kind of situation, and then you end up in a war on your borders, well, then you have some capital that you actually could use. So I think that's a lessons learned, and that brings me, of course, to the notion of stigma. Because we call it buffers, but let's be honest, very few banks view them as buffers. They view them as absolute levels that they should not go under, right? So the notion of buffers, I think, is true for countercyclical, but maybe less so for other so-called buffers, including liquidity buffers. And this is, of course, extremely hard to change, but extremely important to try to address. So let me conclude and say that we, of course, need to have a holistic view on the whole issue of liquidity, non-banks, banks, and also some unintended consequences that came from the regulation after the global financial crisis. And here, I think the ESRB are well positioned to take a leading role when it comes to the macroprudential part of it. So I'll stop there.
So thank you very much. Thanks, Erik. Thanks, Hyun. Thanks, Rafa, and thank you, Linda. Let me. I know that Erik is going to have to go in a few minutes, and so I'd like to ask a question of each of you, and but first, so let me I'll ask you a question about Erik about the issue of central bank balance sheet management, and included, if you want to react to anyone else, that would be of course welcome. As you pointed out, banks seem to want to hold reserves, and so the issue that a lot of central banks are facing now is one associated with their operational framework. So could you give us a little bit more flavor of how it is that you're thinking about a few things? First of all, the desirability of interbank markets, which in the past have been unsecured, uncollateralized markets, and secondly, the possibilities of alternative corridor systems like the one, say, that may be evolving in certain other central banks, say the Bank of England, which has repo and reverse repo. The Federal Reserve has repo and reverse repo facilities and things like that. So if you could expand on that, I think it would be very interesting, because it has to do with the way in which the central bank is willing to provide funding to the banking system.
No, thank you. I think it's an extremely relevant question, and we are now actually exploring that in the Basel setting in different committees, trying to work out the interlinkages between kind of the changing balance sheet environment and the operational framework. So there is kind of one part of that kind of discussion or group of countries that think it's extremely important to have a lot of liquidity in reserves. Others think that, to maybe have some kind of interbank market. I think the pros of having an interbank market is actually that the banks in peacetime actually evaluate each other all the time. They get to learn each other. And I think that's probably a good thing also when you go into a crisis. Of course, the drawback of that, and we've seen that from previous crises, is that in peacetime the interbank market will work. In wartime, it will not, right? So then it ends up in the central bank anyway. But I think there is probably some kind of positive side effect of them interacting every day in an interbank market. But it might be hard to change because habits have changed. If you look on our data, we see a little bit pick up interbank activity actually now. So maybe there is a sign that actually want to go back, because when they end up in the floor in our system, they actually pay 0.10%, so 10 basis points in kind of extra cost, and still they keep a lot of money there actually. And maybe if we were to increase that, and that's, we haven't discussed that, but of course that would be a possibility. That would increase the incentive to have an interbank market. But again, we need everyone to take part, otherwise it will not be an interbank market. But again, I think it's fundamentally changed, because maybe the banks want to have their HQLA, the highly liquid kind of part of the LCR, in reserves, because it is the most liquid kind of asset you could have. And if so, it's going to be very, very hard to change it. So it was a long answer without answering, but anyway.
Right. No, I think it's very interesting. And the two issues that arise when I think about this, first of all, one that comes up, I think, is behind some of what you said, which is that the banks have actually lost the infrastructure, both physical and human capital. Yes. To actually run an interbank market. They don't have the people, much less the systems. The systems are probably easier to regenerate. The other one is that I think that they're concerned, at least the people that I've spoken to, that if they start to face withdrawals, they would much rather withdraw reserves from the central bank that isn't going to tell anyone than try and start selling securities into markets or borrowing from another bank, where that actually becomes known rather quickly in the community. So
that's a good point. And on another note, on stable or not stable kind of funding, we issued many stability report in our context, saying that, well, banks, they actually have a lot of market funding, so that's really unstable. So you should do more deposit funding, because typically we have a big kind of mutual fund industry, so savings go into mutual funds instead, so banks had like 50% funded in the bond market. Well, maybe the bond markets are more stable than deposits, right? So I guess times are changing.
Anyway, again, thank you very much for spending some time with us and for preparing and providing the remarks. And as I said, I know you have to go in a minute or two. Thank you. I'm going to come back this way. Hyun, I guess I did develop a habit some years ago of reading the output of the BIS. And it's a habit that I've retained. And your mention of the FX swaps is a for those of you that haven't read the BIS's work on the FX swaps, I commend it to you. But let me give you the bottom line of one aspect of it. So if you spend a lot of time with the BIS data, you learn a couple of things about the U.S., which you don't learn from US data. You only learn it from BIS data. The first thing that you learn is that there is, in terms of the balance sheet, a US dollar short-term liability banking system outside of the United States that is roughly the size of the US banking system. Just in round numbers, sort of in round numbers, let's just say 100% of US GDP. It's not quite that big, but it's close. And then if you read the paper on FX swaps, you discover that it's actually 2 times in terms of exposure. So my question, which I can ask because we're here and because we're not in the US, is this is a banking system and a system of exposures which are quite complex that do not have technically a backstop from the US. While the US banking system and anything that's going on in US intermediation, ultimately through the banks, is going to have a backstop. What's the responsibility of the United States for this? The United States benefits from this. What's the responsibility of the United States for this exposure of US dollar exposure system that is twice the size of US GDP?
Well, I keep telling Steve that I can only do my job because I can stand on the shoulder of giants. So here's the giant, and I think he's stolen all my best lines. But it's true. It is a very, very large number, and because it's off balance sheet, we tend to not exactly neglect it, but it's something that is not captured, for example, in the capital flow numbers. It's not in Linda's chart that she showed at the very beginning. But it is something that flows from that accounting definition. So in terms of the accounting rules, anything which is a derivative is off the balance sheet, even if you actually owe the principal. And of course, typically when you enter into a swap, if I provide dollars and I receive yen in return, I would normally park that yen in a safe place because I know that I have to return the yen. But I think there's nothing to stop you simply from selling that yen in the spot market, or if you prefer, just invest that yen in the stock market in Japan, and so. In that respect, you have a lot more license in the swap market than you would, on balance sheet. You can see that I didn't answer Steve's question, but in a way, actions speak louder than words. And I think what Linda showed with those very big central bank swap lines, which came into operation during the GFC, and again in March 2020, is that. This is a global, this is a global issue, and the policymakers from all the jurisdictions, including the US, have actually played their part in mitigating the stress. And I think I should just mention one more thing because Linda is also a member of the CGFS, the Committee on the Global Financial System that we have at the BIS. And the BIS data is actually overseen by the CGFS. We are actually giving a big initiative to making the swaps data sort of in a better, to provide more details in the swaps data so that we can actually monitor these risks, I think, better. But there is for the accountants among you, I think there is a very deep question here. So why is it that swaps are not counted as debt, even though repos are counted as debt? So repos are on balance sheet, swaps are off balance sheet. And I think that choice has had major implications for both measurement, but also some of the economics as well.
Thanks. Let me, I guess, one way of addressing this, which we didn't, but is to ask whether or not you've created moral hazard by doing this. I'm not the sort of person that sees moral hazard under every bush, so I don't worry about it all the time. I don't lose sleep over it. But it does come up in thinking about, Rafa, some of the things that you said. So one of the ways, when we were, and I was actually involved for better or worse, so you can blame, I share blame for a lot of the stuff, including stuff that I have later said was a mistake, like the NSFR. But in terms of the LCR and whether or not you want capital and liquidity requirements separately, my question is about the potential moral hazard created by central bank lending facilities, and the idea that you do want to create something that taxes the banks. So isn't part of the answer to why we need an LCR that?
Okay, well, let me.
I mean, I just don't. It just seems to me that you need a central bank lending, and you need the existence of this backstop that creates moral hazard is an important aspect of why you might want certain.
Yeah, but
balance sheet restrictions.
One way in which you could meet liquidity requirements is by borrowing from the central bank, right? And this is not counted as part of the LCR, as far as I can tell. So somehow
Well, there are versions of it that work that way, but let's not.
Okay, but as Erik was pointed out, I mean, this is an issue about the interbank market. I mean, if you reduce the gap between the rate of the marginal lending facility and the deposit facility rate, like they've done in the Eurozone, to 15 basis points, then basically there is no interbank market that can thrive with this very little gap, right? And so there is a decision to basically allow banks to get as much liquidity as collateral they have posted at the central bank with whatever haircuts you have. So, I mean, this is a decision that has been made for good or bad, and I think that we should think of liquidity taking on board the fact that banks can get large amounts of liquidity by borrowing from the central bank. Now, let me say one thing about Hyun's statement that measurement matters and accounting matters. I mean, I absolutely agree with this. I mean, you focus on the FX swaps, but of course you have these unrealized capital gains and losses in your hold-to-maturity market portfolio, and the question is, why is it so? I mean, and when I ask accountants this kind of question, they respond, well, I mean, you have to think that accounting rules are not for the financials. I mean, are for the entire spectrum of firms that are traded in markets, and therefore we cannot have a special rule that sort of for these type of firms. I mean, what's the difference from the perspective of an equity investor between Deutsche Bank and Électricité de France? I mean, these are shares. I mean, they have different balance sheets, and presumably you should compare them using the same accounting rules. But maybe deep down that something should be done when things are so big and so important from the perspective of assessing the solvency and the risks of this particular sector.
We could go down a long discussion.
Let's turn to Linda. Yeah. So thanks again for helping us and demonstrating so much about global liquidity. Let me ask you, since we have here someone I can ask about cross-border capital flows, and what I wanted to ask you about was Erik at the beginning mentioned geopolitical risks, but the geopolitical risks risks must be having some impact on cross-border capital flows, and what are how is it that you see as an interaction between the geopolitical risks and the cross-border flows, and whether or not we're going to see pullbacks in this, and whether there's going to be what we think, at least as economists, as efficiency gains might be lost? I'd be very interested in your view of that.
So I'm going to answer you, but I first
Well,
want
first,
to
yes,
come back.
you'd say it.
And you know, I fully agree that you know, foreign exchange swaps are outside of what I was showing, and that issue is a large set of issue, and the BIS efforts to get more data are very important in this regard. The discussion of FX swaps, the discussion that we've heard also about central counterparties, about how banks are managing reserves at central banks, all of these touch on the issue of risk management by financial institutions. And so swaps in some, you know, in some forms are ways to manage exposures to foreign exchange risk, as well as possibly ways to increase exposure to different kinds of risks and positions. So, you know, I think as we've been talking a lot about regulatory instruments, macroprudential instruments. The other thing that's really important is supervision. And so not only do you have to look at this toolkit that we often think about, but you have to look very, very carefully and kick the tires, as the expression that you would use, on what are the actual risk management frameworks that are in place by institutions, and where could there be other exposures that end up being built up from those. You know, it might look like they're managing risks. We even heard yesterday, for example, about the insurance sector and about reinsurance. And I also read the BIS publications, and there was recently a piece that was highlighting how the reinsurance sector has increasingly been shown to be in offshore financial centers. So what is going on? Or do you have the same level of kind of risk coverage that you might have thought of when you're moving your funds there? So I think there's a bigger set of questions about not just regulation, but supervision that, you know, we have to carefully watch. In terms of your question about geopolitical risks and cross-border capital flows, I think this is of interest across the international policy community. I have recently taken a look at how some geopolitical risks have influenced the official reserve holdings across central banks. And it was interesting that a measure of geopolitical risk that I used was about a country's voting alignment with the United States at the United Nations General Assembly. So how distant, geopolitically distant in some cases from a voting perspective, is a country. Those countries, all else equal, who are more geopolitically distant from the US, were holding higher dollar shares of their official reserves and not lower dollar shares of their reserves. And in some cases, they were even holding higher amounts of reserves, not lower amounts of dollars and reserves. And so one thing that ties into this discussion is that dynamic in the official community, where official institutions need liquidity for these systemic events, their portfolios I think of as divided into a part that's a liquidity tranche and a part that's an investment tranche. The liquidity tranche, you still need to be in the currencies that are used in a lot of these financial transactions. On the investment tranche, the excess
that's perhaps where you see some more diversification taking place from geopolitical factors. So I think these are also things for us to think about in managing these.
Great. So the panel has done a terrific job. The moderator has done a terrible job. And the terrible job is that I've run through our time. And while I would love to get questions, unfortunately, we're continuing to lose panelists. And I know because to travel, and I know that there's another panel and that there are more people, and they're probably going to have similar problems. And so for us to go over right now is really not an option. So I apologize to all of you for not taking your questions, but I'm going to have to end it now. So thank you very much.